Welcome to this special session. We're looking at market versus strategy and potentially when conditions can kill your edge. What we're going to cover in this video is that potentially your strategy isn't broken. It's the market that's changed underneath, and that's what's hurting potential profit. I'm giving you some of the losses that perhaps you hadn't anticipated when you saw a setup on a chart. So what we're going to talk about today is learning to read market state before you trade. And that may help you know whether your edge is likely to show up today, and as importantly, to recognize when to step aside entirely. So you have two decisions, not one, and most traders only plan the second one. So our first decision is to say, what is the market doing before I even look for the trade? So we're talking about a pre-trade state. So if we're talking about a breakout trade, for example, what do we expect before a breakout trade? Well, we expect things like a key level to the upside, a key level to the downside, depending on which way we're expecting it to break. And then a period prior to that breakout where it doesn't do very much. So if we're looking for breakout trades, if that's one of the strategies you have in your toolbox, then that pre-trade state is what you're looking for. Your strategy plan will tell you exactly when to get in, what to do then, and how to get out. So just to reiterate, your pre-trade state defines whether today suits your edge and what kind of move to expect next. Whereas your strategy plan picks the entry move, the setup, and the actual trigger, along with the stop and target you'll actually trade. Now, as I said, most traders focus on this second part and neglect to give enough attention, perhaps, to this pre-trade state. So that's really one of the major things we're going to talk about today. Because it's the state that picks what should happen next. The plan picks the entry move. If you skip step one and step two fires in the wrong conditions, then it's unlikely to give you the outcome that you want. And psychologically, we have this habit perhaps of ignoring some of the information around us when we see a trade on a chart that is saying, well, maybe we shouldn't. So if we look at pre-trade states, there are four conditions and two directional reads. So the first one is coiling, where we've got a range that's potentially contracting a little bit, but we've got some energy building. We've got settled, where we've got a quiet balanced market which is rotating between buyers and sellers, often a little bit of rotation, or pre the next session open or the next data point. We obviously have driving markets, which is a sustained one-way move, and this can have an up bias or a down bias, of course. And then we have failing, where breakouts don't hold. We've got a little bit of a whipsawing market, where really markets not only don't know what to do, but are potentially headline driven to a large degree. And we've seen a lot of that over the last few months. Coiling and settled are two-sided by definition. You can get a failing market, which has an up or down bias, but the up or down bias is very short term. But it's worth referencing anyway. So these are the six pre-market states that you should be looking for. So asking yourself, what's the market doing now? And then, of course, we can start to look at whether our strategy is going to trigger or otherwise. So if we look at coiling market, this is, as I said, the range contracting to some degree. Often we see this lower highs and higher lows, and prices compressing into a narrower and narrower range. Volatility is often falling at this stage, and the market's winding up for its next move, but potentially hasn't chosen a direction yet. Keep it simple. Keep all of these simple. It's just simple market dynamics that we're looking for. So we're looking for swing highs that are lower, and each swing lower that is higher. The ATR, choose a 14 periods falling, sits below its recent average, and bars are shrinking versus the last few days if you're looking at a longer term chart, or few hours if you're looking at a short term. So what this potentially means for you is a breakout is potentially coming, but the direction is unknown. So you need to plan for levels either side of that contraction and wait for the break. Don't trade the chop in the middle. Wait until you've got the proper setup as per your plan. Now that might sound very simple, but if you've got a choice of four strategies, you see a market that's coiling, it's that strategy which should be the one you're looking at. A settled market is not dissimilar but it's usually quieter, it's balanced, it's rotating around a fair value, it's calm, it's two-sided, and price is drifting and rotating around the middle of a defined range with no urgency in either direction. Volatility is often low and flat, not falling or rising, and price keeps on returning to the middle of the range. Moving averages are flat and price crisscrosses them, or even the moving average flirt between, say we have a 10 and a 20, maybe the 10's on top for a little, the 20's on top for a little, but we get very little movement across the board. This is setting up for mean reversion conditions. Obviously, the extent to which that's the case may depend on where the top and the bottom of this rotation is, and obviously where the mean is. And there's several strategies that we can employ to trade this mean reversion strategy, this mean reversion setup. We often see this in the Asian session after the initial open has settled. So what we're looking for is fading the range. We're looking for not chasing either move, but just looking for perhaps when it's moved away from the midpoint. And if we are tempted to trade breakouts when we see this sort of quiet rotational market, then often that doesn't serve us well. Obviously, a driving market is a one-way move which is sustained to some degree with expanding volatility. The market's picked a direction, is committing to it. Obviously, we get pullbacks, but those pullbacks tend to be shallow. Follow through and trend continuation is real, and volatility expands with the move. So we get higher highs and higher lows, or the mirror image if it's driving to the downside. We get a rise in volatility and price pulling away from its moving average. So these are momentum conditions. We can join the drive on the pullbacks, or potentially when it's pulled back and then breaches the previous swing high. Counter trend fades tend to get overrun in this state, so don't be tempted to do so if that trend is strong. It's one of the key reasons why looking at a longer time frame is good in a driving market. So momentum strategies probably rule here, but also trend continuation to a degree. Then we have a failing markets where breaks don't hold, the moves reverse on us, we get lots of fake outs. This is what probably the most dangerous state. Not many strategies would suit this sort of market unless you're sitting over your computer for some time. So we see that sucking in of traders, hopeful that we may see a continuation of a move either side. So both breakout and traders who trade trends get chopped. So we see regularly pushing through key levels, close back inside the range, long wicks on both sides of the bars, and also wide erratic bars that keep on changing direction. So we'll maybe get one or two in one direction, then a couple in the other. So really, this is a market that's, generally speaking, one to stay clear of with most strategies. It does kill, as I said, both trend strategies and breakout strategies. So momentum and breakout strategies are really off the table in this state. There may be some scope for some degree of mean reversion should this failing pattern continue for some time. But remember, not taking a trade is always a position. And so in many cases, you would be quite entitled and quite prudent just to step aside. And as I said, then we add direction. So driving and failing to a lesser degree give us an up or a downward bias. And as I said before, we can tend to substantiate our upward bias by looking at a longer time frame. We see that swing structure of higher highs and higher lows. It's really not rocket science. And the opposite, of course, is the case for a downward bias. And of course, that direction tells you which side to join or which side is more likely to join. So if you do get a breakout to the upside, it's a downwards bias on the longer time frame, then that in itself is a note of caution. Now, that's not the whole picture, of course. We have got context beyond the state itself, and there are three checks that sharpen any pre-trade read, which would suggest that you have, in some way, shape, or form, in your trading strategy plan. that higher time frame consistency for most strategies, with the exception potentially of a mean reversion, would be worth including. So does the longer term time frame, a daily or a 4 hour chart, if you're trading an hourly chart, for example, agree with what you're seeing on your primary trading platform? If it isn't, or if it is in sideways trend rather than downtrend and you're looking for an up move, you're fighting the higher time frame, and it is more likely to fail. We know, we can look at any chart and we can see it, that retracements on any time frame are shallower when they're against the trend. So a higher time frame measure is worth a line in your trading plan for sure. Even if it's a case of saying, well, look, we've got a higher time frame which is unconvincing, therefore what I'm going to do is I'm going to alter my position size accordingly, perhaps less than I would normally trade. So you can put things like the longer time frame moving average, we've already referenced this, and look at which way it's sloping. It's really a simple tiebreaker when structure looks unclear. That slope of the moving average, even if it's slight in your direction, is important. And then probably one that most traders miss is the proximity of the next key level. How much room does the move have before the next obvious support, resistance, or round number? If you're entering 2 pips below a wall, it's a plan problem, not bad luck. And what we tend to do is we tend to look at charts optimistically when we look at profit targets, ignoring those short-term potential turn points, which even if they just touched a couple of times, are nevertheless still liquidity traps. So set yourself a goal, perhaps, of saying that you're not going to enter a trade if the next key level or round number is less than 1.5 ATR away, as an example. So what we're trying to do is match the stake to the play that we're making, or step aside, of course, because that's a decision too. So if we're looking at a coiling state, then what tends to work more so is breakout plans, waiting for the break either side, and stand down until the range resolves if it doesn't fit your plan. In settled markets, we're often looking for mean reversion, no breakout or momentum entries here, or they're less likely to work if you should take the plunge. Driving markets is trend continuation, where you can join the pullbacks or wait for the breach of the previous swing high. And then momentum trades, of course, also work if you're trying to pick a mid portion of the trend, such as using a parabolic SAR. And then our failing markets, very little strategy works with this. Experienced fade traders only, small size, more often than not, stepping aside is good. Potentially may work for some mean reversion if that failing market does have a higher range between the top and the bottom, even if it is failing. In that case, it might suit a smaller time frame than perhaps your primary. So I hope that's been useful, giving you some things perhaps to think about adding to your plan. And remember, the driving and failing only has direction applied. Join the drive side or not, which break just failed. Coiling and settled have no side. So here's your checklist before you start. Which stage is it? Is it coiling, settled, driving, or failing? Pick one, commit to it. And then look for the strategy once you've decided, particularly if it's a driving or failing market, is the right part of your trading plan to action. Does the higher time frame agree? And where's the next level? Is the proximity enough to allow your trade to breathe, or is it going to get taken out or reverse back towards the level that you got in at in a very short space of time? And then, of course, you've got that ultimate decision to make. Does my edge that my strategy will give me in the ideal market conditions fit this market state or otherwise? If the answer is no, then perhaps no trade, or at least a lower position size is the way forward. So takeaways, your edge is conditional. Strategies rarely break. Conditions are the deal breaker. When they change, so may your strategies that may optimize your returns. So classifying the state first, adding the context, and remembering, of course, that if the state doesn't suit your edge, stepping aside may well be a winning decision. One thing I would suggest you do, from a practical point of view, is go back and have a look at the trades that potentially did work out for you and potentially trades that didn't, and see what the market was like pre-entry. Was there any clues in there which, if you'd adopted what we've talked about today, may have served you well? We'll see you again soon. Bye-bye for now.